Hey, Winston here, and today we are going to talk about how to run your numbers if you're looking at buying a new home or building a new home or whatever asset you want to buy. How do you run the numbers? How do you figure out whether you're going to make a profit, not make a profit, regardless of what you're buying? So this right here, we're going to be talking about buying a home, obviously, because that's what I center around, but you can take what we're talking about and you can apply it to whatever you would like to apply it to. So we're going to buy a home right now, and that cost of that home is going to be $200,000. When you're running your numbers, you're going to insert whatever number you think you're buying this house for, or whatever number you're offering on the house, and you're going to put your number there, okay? That number interchange was whatever you want to put in there. The next thing we're going to do is we're going to figure closing costs. Now, I'm figuring closing costs at 6% on this because this particular deal, as we're looking at it, or I'm sorry, at 3%, we're not paying for a bank to do anything. This is an all-cash deal, so we're not paying as much in closing costs. If we had a bank loan being done, there would be some origination fees and some more costs that's added from the bank side. So we're not doing that on this one. So that closing costs, if you're doing a loan or something, that may go up to 4% to 6%, somewhere up in there. You just got to call your bank, find out what it's going to cost for origination fees and everything on your loan. I'm going to go through this real fast. What are our closing costs? We got attorney fees, origination fees from your bank. We got prepaid interest if you're going to buy down your rate. Escrow deposits, that's taxes and insurance you put in a deposit so that the bank always has that money to pay your taxes and insurance when it comes due every year, and you don't have to actually save for it. Recording fees, there's going to be a fee to record it with the state and the county. There's going to be a fee that they're going to charge you to underwrite it. They're going to check over your books. They're going to make sure everything is legit, everything is okay, you can afford to do it. And they're going to charge you a fee for that because that takes time for somebody to do that. Then they're going to have some prorated taxes they're going to do, some insurance, home inspection fee if you're going to get a home inspection, which I would definitely recommend. So on this particular house, we said we had 3% closing costs. I'm also looking at the house and like, okay, I got to put some money into it. So we're going to put a new kitchen in it. We're going to put a new roof on it. We're going to do several things to it. So I'm going to do $48,000 worth of repairs. So my total investment in this particular home will be $254,000. That is going to be the number we're working with, the $254, for the purchase price. It'll include all of this. That's what total out-of-pocket money. Our yearly revenue is going to rent for $2,500 a month. $2,500 a month. We multiply that times 12 months, and what do we get? $30,000. Simple math, even Nick can do that math. You could do that, right?
I think so. I would take your crack at it.
Probably got to have your phone out and stuff like that still, maybe. Yeah. It's amazing how dumb we get as, I am getting more and more like I use my phone for everything where I used to never use it, like 2 times 6. So $30,000 a year on revenue. I'm going to do the revenue, I'm going to do everything by the year, not necessarily by the month. A lot of times when I break stuff down, I'll break it down yearly and monthly because I want to look at it both ways. But ultimately, to get my return on investment, I need to know what I'm going to produce for a complete 12-month period of time. Now we're going to do a vacancy factor. What is a vacancy factor? A vacancy factor is, I'm going to look at that house, I'm going to say, well, you know, once every 14 months, that house is going to come vacant. Once every 14 months will be a 7% vacancy factor. So what I want to know is, I want to know if this house goes vacant and I am really getting by the skin of my teeth in my finances every single day. So I don't have a lot of extra money to come up with $2,100 for this month if I needed the $2,100. So I need to do that. I charge a vacancy factor, then I would divide that by 12 and I would put that much money into an account every single month. So at the end of the year, I have that money in an account. And then I would let it build up a little bit too. So you just keep on putting it in there. If you don't use it, you don't use it, but at least have it there. That way you always got that cushion and you don't have to worry about it. So vacancy factor is always important. I use 1 month every 14 months pretty much on everything. I never use less than a 7%. And this would be unique to your investment. I mean, if you go into to an assisted living place and you're renting out a room to somebody that's in assisted living, that you may be renting to them till the day they die. So you don't have a huge vacancy rate. If they're 85, maybe your vacancy rate may only last 12 months. If they're 65, you may have 10 years, 15 years they're going to rent from you in that little portion of real estate that you own. So it is unique. You got to figure it out. But I'm going to tell you right now, before I would ever undercut it and try and make my numbers look good, I would overestimate it and make my numbers look bad because I want my numbers to work in the worst case scenario just like I want them to work in the best case scenario. So if I figure my numbers up and they don't work in the worst case scenario, I need to walk away from that deal because if I don't, then that's going to cause me, eventually it's going to cause me some type of a failure, catastrophic failure. So the total revenue, we'll take the $30,000, we'll subtract the $2,100. Now we got $27,900. We're going to use that number as far as our total revenue rather than using the $30,000. because I want to take into consideration this vacancy factor. Now, after we do the vacancy factor, I'm going to put in here property management fees, and I'm going to use 8% on property management fees. You say, well, I'm not going to use a property manager. I'm going to manage it myself. And I manage my own properties. But my labor isn't free. The people that work for me, their labor isn't free. So if you're going to manage it yourself, you should get paid for that time you spend managing it. And if the business won't pay you for the time you spend managing your home, then you probably don't need to get that home. If you start saying, well, I'm not going to charge, I can spend time over there, I'm not going to charge that, at least understand that you're cheating yourself out of a little bit of profit on that. I do that myself sometimes on stuff. I'll mow my own grass because I want to, but I don't, and I look at it like I ain't doing nothing else, so I just go mow the grass. That may be your case, that's fine, but just understand it. Understand it that $2,400, something happens to you and your spouse has to come in and manage that right there. Do they have the ability to manage it, or are they going to use a property manager? If they're going to use a property manager, it's going to cost them 8 to 10%. We need to put that in there so that when they run the numbers, it's there, okay? Never leave any numbers out that may cause you some issues. Next thing we're going to consider is insurance. So we got a $254,000 house. That insurance is going to be about $1,500 a month, or I'm sorry, a year. We got to put that in our equation. Next, we're going to go into our property taxes. How much do we need to pay on property taxes a year? Understand whenever you're buying a piece of property that if you look at Zillow, you look at the different places that have property taxes, they're going to give you the property taxes on this house, but the property tax is going to be at whatever value it was assessed at the last time. So if somebody bought it and they raise it 2, 3, 4% a year, year over year over year, and it doesn't keep up with inflation, and you go buy it and their tax appraisal says it's at $160,000 and you got it at $250,000, and that's what you got in it, they're going to charge you $250,000 on your taxes, so it's going to go up that much. So understand, you need to do the math on that right there on your property taxes. Do not assume anything. Do not assume anything on insurance. Call an insurance agent, find out that the insurance is going to be right. Make sure that you know exactly what you're going to pay, and don't guess and don't take fictitious numbers off of Zillow and different sites like that. Verify with your local provider, whoever you're using for your insurance. Your local real estate agent will help you get some of the property tax and stuff. Now just make sure you got everything. Don't just run off of it willy-nilly. Get it, make sure it's right. It doesn't do us any good to go out and work our behinds off and work our behinds off and work our behinds off and save up and save up and save up and go buy a house, and then that house still costs us money. We got to get that right. We're going to put a maintenance fee in there of $500. So I figured $500 a year on maintenance. All of my properties, whenever we put them in, they are 100%. I don't rent something that isn't. So if you're renting a property and you say, well, it's going to need a water heater, then you need to put something in there so that you can replace that water heater in 12 months or whatever it is. Add a little bit of money to an account. You know, you got stuff that needs to be done to it. You know, you have to figure in. If your air conditioner is 10 years old, you may have a couple of service calls in that. Those service calls may cost you $800 a year if you're not careful. If you got a bad water heater, that's going to cost you more. If you don't fix it in a timely manner and you got to fix it on a Saturday because that's when it breaks, that's going to cost you twice as much money to fix it. So just pay attention, pay attention, pay attention. But I use a $500 number on that, and I got multiple properties, so I kind of spread that across everything, and a dollar cost average on some of that also. You have to do what works best for you. So in legal and accounting, I factor in about $400 a year to cover any legal expenses I'm paying to, if I got to talk to an attorney about something or anything like that. And then I also have accounting. I'm gonna pay my accountant something for each individual property that they're managing for me. So I gotta pay the piper. Next thing I'm gonna do is I'm gonna take my total expenses. So I add all my expenses up. That comes to $8,500. That's gonna be our total expenses. We're using a 27.9 as our total revenue. That's gonna give us 27 minus the 85 is gonna give us $19,350 a year that we're making off of the house, right? We take all our expenses out of it for the year. We put all of our revenue to $30,000. We take out the vacancy factor right there. Now we got 27. We're taking everything from a worst case scenario. What if this happens? What if that happens? Can we make it? Can we make it? Can we make it? And yes, we got 19,000. So let's see what that return is. We'll take, to get your return, what you got to take is this $19,350, and you have to divide it by that $27,900. I'm gonna fast forward through this slide right here. Well, I say that, we'll just go down and read it. So right here, we're talking about your rents equal your income. And whenever we're figuring everything out, we want your total expenses. That means every single expense you have. If you're going out and buying a nail, it needs to go into that property. We need to charge it off of that property, and we need to know where our numbers are. Take your rent, subtract them from your expenses. This gives you your total cash flow. We just saw that on the previous slide. Your income minus expenses is cash flow, other known as your net operating income, NOI, total cost of property, gives you your return on investment. So your NOI divided by total cost of the property gives you your total return on investment. And that's what it's all about, right? We're going to invest money. We want to know what we're getting for it. So now we divide that. It comes to 7.6%. So that would be a cap rate, or that would be our return on investment. Some people have struggled with the fact of me using the word cap rate. That's just how I was taught. Cap rate is used more on commercial than it is residential, but it's the same thing. Your return on investment, your net operating income, it's all the same. It doesn't matter. So I got 7.6% right there on the cap rate. Would you buy it for 7.6%? I think right now in today's market, Nick, 7.6 is about as good as it gets. I mean, it's not a bad return right now, and it ain't what it was a couple years ago, but it's not bad. All right, we're not gonna go over that. We'll come back and do a different slide in a little while, but that covers running the numbers. Y'all have a great day.